if you really, sit down and think about building serious, life-changing wealth, not just saving for a rainy day, but really moving the needle.
Yeah.
Where do you put your money?
It's the big question.
It's the question that keeps us all up at night. I mean, do you buy gold bars? Do you scrape together a down payment for a house? Do you launch a business? Or do you just dump it all in the stock market and hope for the best?
It is the eternal question, yeah. And usually the answer you get depends completely on who you're asking.
Totally.
A real estate guy will tell you land is the only thing that lasts. A banker will sell you on bonds. A crypto bro will tell you everything else is a total scam. But today, we're looking at this through a very different lens.
We are indeed. We're diving into a stack of insights from Monesh Pabrai. And for anyone who might not know the name, Pabrai isn't just, some guy with a YouTube channel.
Oh, no.
He's a legendary investor, often called the disciple of Warren Buffett. This is the guy who famously paid over $500,000 just to have lunch with Buffett.
Which, when you think about it, was probably an amazing investment for him. The ROI on that lunch must be incredible.
Exactly. But what's so cool about the material we have today, specifically this lecture he gave on asset classes, is that he isn't just giving us stock picks. He's not saying buy this or sell that.
No.
He is offering a completely unique mental model for why the stock market is structurally, fundamentally different from every other asset class out there.
Right. And that is the core of our deep dive today. We want to understand this concept he calls auction-driven markets. We're not just going to talk about buy low, sell high. That's a cliche. Everyone knows that.
We've heard it a million times.
We are going to analyze the structural weirdness that makes a stock behave so differently than, say, a house or a private business you might buy.
And here's where it gets really fun. We're going to talk about how to exploit that weirdness. Sometimes, that means buying stocks. But, as we'll see later on, sometimes it means doing something completely different that, honestly, I did not see coming.
Fantastic story.
It involves a strategy Pabrai used to make millions without actually buying the stock he was looking at.
It's a brilliant pivot. But to get there, we first have to understand the mechanism. We need to unpack this whole idea of the auction versus the appraisal.
Okay, so let's start there. The basics. Pabrai starts by pointing out something that seems obvious at first, but is actually really profound. The stock market is an auction-driven market.
Right.
If you hear stock market, we think charts and tickers, but explain the auction part.
Yeah.
Why is that word so important?
Well, think about how most things are sold. You go to a supermarket, there's a price on the milk, it's fixed. You don't haggle.
Right.
You buy a house, there's usually an appraisal. An expert comes in, looks at the square footage, looks at comparable sales, and says, this is what it's worth. It's a calculated, kind of slow process.
It feels scientific almost.
Exactly. But the stock market is a continuous double auction. You have millions of people digitally shouting, prices at each other every single millisecond. And because it's an auction run by humans, it has this very specific feature. It is prone to extreme emotional swings.
It gets depressed and it gets euphoric.
Yes.
Okay, but we hear that all the time, right? The market is emotional, Mr. Market is manic. It usually feels like a metaphor. Pabrai brings actual data to prove this isn't just a feeling. He talks about the 52-week range.
He does. And this is a data point that I think a lot of people just gloss over because it's on every stock quote. But Pabrai says, no, stop and really look at it. If you throw a dart at a stock on an exchange, he uses Indian examples, but this is true for the S&P 500, anything. And you look at the price range over just 1 year, the fluctuation is massive.
He mentions even for a stock trading around, say, 100, the range might be 60 to 130. Or 100 to 250.
Exactly. And crucially, this happens even with massive blue chip companies.
Yeah.
He specifically mentions Reliance Industries. Now, for context, Reliance is huge. It's a giant conglomerate. It's not a meme stock.
No, it's not some crypto coin with a dog on it. It has oil refineries, telecom, retail. It's a real, tangible business.
With factories and predictable cash flow.
And yet, Pabrai points out, even with a company like that, the stock price can easily double or get cut in half within a single 12-month period.
Which is just insane if you actually pause and think about it. The business itself, the actual factories and cell towers, they didn't become half as valuable or twice as valuable in 6 months.
The cash flow didn't change by 100%, but the price tag did.
That's the disconnect.
That is the disconnect. In an auction market, price is often detached from intrinsic value because price is just set by the most emotional buyer or seller in that exact second. And to explain why this is so weird, he uses this hilarious analogy about real estate in Mumbai.
I love this analogy. It just perfectly exposes the absurdity of the stock market. So let's walk through it. Imagine you own a nice apartment in Mumbai.
Okay.
Or New York, London, wherever. Let's say it's in a nice area.
So it's a tangible asset. You can touch it. You know roughly what it's worth. Exactly. And let's say you have a friend who is a real estate broker. A very, very patient friend. Because in this thought experiment, you call this broker every single day to ask what your apartment is worth.
Every day?
Every single.
Yeah.
So January 1st, you call him, hey, what's my flat worth? He says, it's worth 6 crores. You feel good.
6 crores is a lot. You go to sleep happy.
You do.
Yeah.
But then you call him the next day, what's it worth now? He says, it's 6 crores. You call him the third day. And finally, he just snaps, listen, you idiot, it's still worth 6 crores. Nothing has changed.
Because in the real world, the value is sticky. It doesn't jump around minute by minute.
Right, but you keep calling. And maybe after 30 days, he tells you, oh, there's been a little movement. It's 6.1 crores now. Pabrai's point is, over a whole year, that apartment's price might drift between 6 and 7 crores. It's a tight, stable band.
It's stable range. But, and here's the key insight, if you took that exact same apartment, put it inside a company, and listed it on the stock exchange, the market psychology would take over. In that same year, the ticker price for your apartment would likely bounce between, say, 3 crores and 9 crores.
That is the aha moment for me. The asset is the same.
Mm-hmm.
Same wall, same view. But because it's now a piece of paper being traded in an auction, the price is just wildly volatile.
It's called attenuation. The auction dynamic amplifies everything. And this is what Pabrai means when he contrasts it with non-auction markets, like private equity.
Right, he calls that an intelligent buyer facing an intelligent seller.
Precisely. And this really explains why private equity is so different. Let's say I'm a PE investor looking at a business in Turkey, to use one of his examples. The business makes, I don't know, Coca-Cola bottles. It's solid. It's worth maybe $25 million. If I walk in and say, hey, the stock market's down, people are scared, so I'll give you $16 million for your factory, what happens?
They laugh you out of the room. Security probably escorts you out.
They absolutely laugh you out of the room. Because there's no panic in that room. There's no ticker tape. It's just two people discussing the value of a productive asset. You're not going to get that crazy discount.
But in stock market, you can buy that $25 million business for $16 million.
Or a slice of it, yeah. You can buy 10% of that business at a massive discount just because other people in the auction are feeling pessimistic that week. That is the structural advantage.
And that's why he prefers stocks over something like gold or art.
Generally, yes. Gold is a commodity. It's priced globally. You don't walk into a shop and find an ounce of gold selling for half price because the owner's having a bad day. The market's too efficient.
So the first big lesson is that volatility is actually your friend. I think most people get scared of it. They see their account drop 10% and they panic. But Pabrai is saying the fact that stocks are weird and bounce around is the only reason you can make real money.
Correct. You are exploiting the mood swings of the other bidders. You wait for the auction to get depressed, the room goes quiet, and you buy dollars for 50 cents. That's the classic value investing playbook.
But wait, this is where we have to flip the script. Because buy low is investing 101. We all know that part. But what do you do when the market is crazy expensive? When the auction is, overheated and euphoric?
This is the second part of his thesis, and I honestly think it's the more insightful part because it's so counterintuitive. He talks about the 1990s, the tech boom.
Oh, yeah. The dot-com bubble, pets.com and all that. Valuations were completely unhinged.
They were. Pabrai mentions looking at software companies trading at price-to-earnings ratios, PE ratios, of over 100.
Just for context, let's break that down. A normal PE might be, 15 or 20? Meaning you pay $20 for every $1 of profit. A PE of 100 means you're paying $100 for every $1 of profit.
Right. It implies you're expecting massive, explosive growth. Now, a typical value investor sees a PE of 100 and says, too expensive, I'm out, this is a bubble, and they walk away.
Which is so hard to do, by the way. Sitting on your hands while everyone else is getting rich on paper is. It's psychologically painful.
It's incredibly hard. But Pabrai didn't just walk away. He saw a signal. He realized a high valuation wasn't just a warning sign. It was also information. It meant the market believed this product was in incredible demand.
Okay, so the high price is telling you something.
It's telling you that company has a low cost of capital. They have infinite ammunition to grow.
So he looks at this company called PeopleSoft back in the 90s. They made HR, software, payroll, benefits, that kind of thing. And they were trading at these insane valuations. He knew he couldn't buy the stock. It was too risky. But he asked a different question.
A better question.
If this company's growing this fast, what is their bottleneck?
That's the critical question. What's the bottleneck? And for big enterprise software, the bottleneck is implementation. This isn't like Microsoft Word. You don't just click install.
No, it's massive. It hooks into your bank, your taxes, everything.
It takes teams of people to install it. And if PeopleSoft is selling software like crazy, which the stock price tells you they are, then there must be a huge shortage of people who know how to install it.
So Pabrai decides, I'm not going to buy the stock. I'm going to start a business that helps people install the software.
He decided to sell shovels in a gold rush. The high stock price was the signal that a gold rush was on.
And the best part, he admits this, He didn't even know how to spell PeopleSoft.
He really didn't. He had zero experience in HR software. He was an IT guy, but not in the specific niche. But he understood the economics.
So let's break down the $1,000 investment, because this story is just, it's a masterclass in low-risk, high-reward thinking.
It is. It's pure arbitrage. So he knows he can't do the work himself. He needs a practice leader, someone who really knows the software. But these guys are expensive. Maybe a $250,000 salary back then.
Which is a huge liability if you have no clients. Most people would say, I can't afford that. I need VC funding first.
Right. But Pabrai just places a single classified ad. I think it cost him $1,000. That was his entire initial investment.
$1,000. That's it.
Through that ad, he finds a guy named Paul Yates. Paul is an expert, a real heavyweight. Pabrai interviews him and makes him an offer. Come work for me. I'll pay you a $250,000 base plus upside.
That's a bold move. You're on the hook for over $20,000 a month in salary with zero revenue.
It looks risky on the surface, but check out the timeline. Paul accepts, but says he can't start for 2 weeks. Before Paul even starts day one, he calls Pabrai. He says, hey, the client I'm currently freelancing for, they want to know if my new employer, you, will hire me back to them as a consultant.
Wait, what? So the client just wants to keep working with him through the new company?
Exactly. They didn't want to lose him. So Pabrai asks the magic question, Paul, what should we charge them? And Paul says, well, the going rate is about $3,000 a day.
$3,000 a day in the 90s.
$3,000 a day. Pabrai, trying to stay calm, says, tell them yes.
I bet he did. Let's do the math on that. $3,000 a day, maybe 20 working days a month. That's $60,000 a month in revenue.
Against a cost of maybe $25,000 a month for Paul's salary and benefits?
So he's clearing $35,000 a month in profit. Instantly.
And think about the cash flow. The client pays the invoice, and then Pabrai pays Paul. He doesn't even have to front the cash for payroll. The capital efficiency is infinite. He turned a $1,000 ad into a cash machine before his first employee even started.
It's incredible, but it didn't stop there, right?
Right.
One guy is nice, but it's not a huge business.
No. And this is where that high-growth signal from the stock market pays off. A week later, Paul calls again. The client is desperate. They need more people. They need a team of 12 developers.
12.
And Pabrai asks, do you know any developers? And it turns out Paul is the president of the PeopleSoft user group in Chicago. He knows everybody.
Of course he is. Wow.
So Paul recruits a dozen guys. They cost about $150,000 a year each, but Pabrai bills them out at $2,000 a day.
So the spread on each of those guys is massive. You're billing $40,000 a month per head and paying them maybe $12,000 or $13,000.
Massive margins. The company, TransTech, went from zero to millions in revenue almost overnight. And the key insight, he says, is that he made far more money starting this service business than he ever would have buying PeopleSoft stock, even if it had gone up.
It's just so ironic. He used the stock market not to invest, but as a roadmap. The insane valuation was a valid data point telling him there is a desperate shortage of supply over here. Go fill it.
Exactly. He was surfing the wave created by the auction market's euphoria.
This really changes how I look at market bubbles. Usually I just think stay away, but Pabrai is saying no, get closer. Just don't buy the stock.
Don't buy the asset, sell the service. That's the mantra.
Which brings us to the bigger philosophical point he makes. He talks about his investment style being an inch wide and a mile deep.
Yes, this is his argument for why he sticks to the stock market ecosystem. He calls the stock market a unique mousetrap.
A mousetrap. That sounds a little ominous.
He means it's a mechanism designed to catch value. Because it's an auction, it serves up these opportunities that other markets just don't. In the gold market, you never find gold for 50% off.
Right, it doesn't happen.
In the art market, you rarely find a Picasso for pennies because the seller is having a bad day. The dealer network is too tight.
And in bonds, the math is too precise.
Exactly. But in stocks, you get two distinct types of opportunities. One, the market is depressed, the auction is dead. You buy great companies for pennies on the dollar.
And two, the market is euphoric. The auction is crazy. Prices are through the roof. You don't buy the stock. You use that high price as a signal to build a business that serves that overheated sector.
Precisely. So Pabrai's point is, why go hunting in less favorable pastures? Why try to get rich in real estate or debt where everything is pretty efficiently priced? Stick to the one place where people are guaranteed to be irrational. Stick to the auction.
It's a compelling argument for just specializing. Instead of trying to be good at everything, crypto, gold, startups, just master the weirdness of this one market.
And realize that investing doesn't always mean buying shares. Sometimes it means reading the tape and acting on that information in the real world.
So let's bring this home for the listener. We've unpacked a lot. First, we've got the Mumbai apartment analogy. Don't let the daily price swings fool you into thinking the real value has changed.
Right. Volatility is just the price of admission. If you can't handle the apartment dropping from 6 crores to 3 on paper, you shouldn't be in the game. You have to have the stomach for it.
And then we've got the PeopleSoft lesson. When you see a bubble, don't just dismiss it. Ask what it's telling you.
Ask, who is making money off this demand? And can I be the one selling the services? If AI is the bubble, don't just buy the hot AI stock. Ask what companies need to implement AI and if you can provide that service.
That's the perfect place to leave it.
Yeah.
But I want to give our listeners a specific thought experiment to chew on.
Let's hear it.
Look at the market right now, today. Which companies are trading at absolutely insane valuations? Is it AI, green energy, biotech?
There's always something. The option never stops.
Instead of asking, should I buy this stock? Hey, ask yourself Pabrai's question. What service is this company going to desperately need to justify that valuation? And could you be the one to provide it? Maybe starting with just a $1,000 ad or these days, maybe just a LinkedIn post.
That is the billion-dollar question, and the clue is sitting right there in the